Thanks so much, Jonathan. A fantastic opportunity to see some of the most promising founders there, and certainly ones to watch. Our next session promises to be just as gripping. Focused on angel to venture, I'm pleased to welcome to the studio Rod Beer from the UK British Angels Association. He will be chairing the panel. Rod.
Thank you, Amy. And so, yeah, we've heard from Henry earlier about how we've seen record numbers, or going to see record numbers this year around the Series A space. And also, as Henry alluded to, the lines merging a little bit between seed and Series A. So it means that the kind of transition from angel funding to VC funding is becoming ever more important from a founder's perspective. So this session will hopefully lift a little bit on how those relationships work. And joining me today in the studio, I've got Jeffrey Faustin from Jensen Funding Partners. I'm also joined by Katie Marash from Jamjar. I've got Carlos from C Camp and Chris Adelsbach in Angel and now VC as well. So welcome everyone, and thank you so much for joining us. I want to open up a little bit with quite an open-ended question to you, Jeffrey, as you're here with me. Why is it important for angels and VCs to work together?
Well, I think it is important for angels and VCs to work together because, for me, it's key to the early stage success of the business. I mean, it's about having a common goal. You know, angels and VCs both want the same thing. They both want to have companies being successful, and both want to get great returns from that. And so being able to work towards that common goal, I think, is really, really important and to get a positive outcome. But, you know, it's also about having a successful transition. And by that, what I mean is, you know, companies need to raise investment, and they do so at different stages from different sources of funding. And for me, what is really important is that really the transition from that funding source is key. I like to think of it as, you know, a relay race where you have the passing of the baton. And that's really, really key, you know, not letting the baton drop. And the issues that we see in making that happen, making sure that doesn't happen, is around two things, really. One is with the terms and evaluations that come in at the angel round. You know, it's really important for that to be conducive to VCs when they're following on. And also anything, actually, for that matter, that has a disproportionate control or ownership of that business. Now, you know, we at Jensen, we have one of our funds is an early stage pre-seed fund. We've done well over 100 investments in that pre-seed fund. So we work with angels, we co-invest with angels very regularly, so we work with them very often. And one of the things that we do is we have, in order to try and alleviate that, is we have very light touch term sheets, which we use to try and help ease in that transition. As a matter of fact, you know, we have a deed of adherence letter that's really, really simple and straightforward for our angels to co-invest with. So that really makes it easy to have that transition. You know, all in all, it's really about having a common goal and having that smooth transition, as far as I'm concerned.
Yeah, Chris, what have you had? I'm sure you've invested an awful lot of business at angel stage. You're now investing at VC stage. You've been on, I guess, both sides of the fence many times. What are your views around the importance of angels and VCs working together?
Thanks, Rod. Yeah, I mean, I think generally, I think the relationship is quite good. I think everyone needs to understand their role in the evolution of a company. You know, angels should be angels, right? They should be people that are supportive and act as mentors to the founders. But I've even have had experience as an early investor where I've spoken to a founder, and the cap table has been broken because somebody who called themselves an angel came in and took 50% of the company, and they're not even a founder of the company. Which is remarkable because you expect that's the sort of problem that you have much later where founders maybe don't have sufficient equity to incentivize them moving forward. But I guess rare, but I have is where cap tables just are not structured to incentivize founders moving forward. And they've almost become uninvestable to an angel, let alone a VC.
And so it's important for the angel to kind of take their part in ensuring that the VCs are going to still have strong appetite as a company grows. Katie, from your perspective, do angels, when they move on to the next round, do they just kind of hand over the keys and step back, or do they continue to make an active role moving forward with some of the businesses that you've worked with at Jamjar?
I think that the roles inevitably change. So as Jeffrey alluded to, there potentially is some baton passing, but at the end of the day, it's just people. So angels are people with their life experiences, and VCs are full of people with their life experiences. And a lot of the time, there's value that different people around the table can add, maybe in different amounts, but right up until, in some instances, the exit of the company. And you can have angels that are true confidants, and they're not looking to deploy more money. So in some instances, the entrepreneurs can have more of a kind of off-the-record chat with them. And equally, there's some where they feel that, there's not much they can add post-Series A or whatever. So I think it varies. But I think as an entrepreneur, it's always good to be aware of the background of the people investing and reach out when there's specific problems that they've solved well in the past and you think they may be able to help with, because you'd be really surprised. There's a lot of highly successful founders themselves who are angels who have gone on to successfully exit businesses themselves. And so actually that experience can be really useful along the way. It's not always the case that they want or have to totally step back from any advice.
Oh, interesting. Carlos, at Seed Camp, you're doing a huge amount of work around that kind of, surely that transition period between that seed up to early stage, Series A and beyond. What have you seen around that kind of the importance around angels and VCs working well together as well?
Yeah, so I think the fun part about a conversation like this is that we can operate in generalities. And of course, we all know that it's the specific individuals that make or break something. But in the spirit of generalities, I think I want to just underpin that angels are the foundation of the startup ecosystem. Like they weren't before as much because I think that the flow of capital was enabled by a lot of tax incentives. Now it's a lot more than just about that. Now it's a new wave of people who want to give back. So I would say there's probably two versions of angels. Way back when it was high net worths with a passive contribution and sometimes toxic, to the example Chris gave. And then now the very current form of angels are industry operators, people with experience, sold their own companies or have worked in high growth companies and are very active in value add. So generally speaking, it is such a core foundation of a high growth company now to have those angels involved.
Yeah, it's really interesting. You said that our recent research that we did alongside the British Business Bank showed that angels are deploying at least £1 billion every single year into very early stage businesses. So I appreciate you mentioning the importance of the ecosystem. And Chris, from your perspective, when have you seen, it's great to see that great kind of handing the baton, as you called it, Jeffrey, or passing it, handing over the keys from an angel to the VC. When have you seen it where the VC's not been so good at that kind of angel relationship piece? Have you got any examples that we might want to shout out to some of the VCs in the community and our fellow panelists as well?
Thankfully, not many examples of that. I think that when it works well, you have the founder, the angels, and the VC and growth capital kind of working together as a team, because we all want the same outcome. But ultimately, when I invest as an angel, I tell the founder, I sort of work for you now, right? You don't work for me, I work for you. So here's my money. Now tell me how I can help. Ultimately, I think we're aligned. Where it hasn't worked well, and again, this is a rare instance. Perhaps you backed a company as an angel, and then all of a sudden there's a larger round, and you've been crowded out. You have not been able to take advantage of your pro rata, which is tough, right? And I can see why it is the case sometimes. But generally, it's because a VC is fixated on perhaps 20% ownership at the next round, and then there's a struggle to actually bring in the additional capital. But that's a rarity, and I think that does not sit very well with a risk-taking angel. And hopefully, that's something that VCs are aware of as well, and maybe come off that position, because ultimately, I think it's in the VC's best interest to keep that team together. Especially if the angel is a subject matter expert, a value add person. There's an assumption that a VC will come in and sit on the board and be more value add than the angel, and often that's not the case, because VCs are smart, but it's a broad church, and they're not necessarily an expert in absolutely everything they invest in.
It's a small world, right? People chat, people know each other, people, it's a community around the early stage space as well. So it's always good to do right by people. So I wanted to kind of touch in a little bit more about, I guess, from the VC's perspective, for the lot of founders, I imagine, watching who'd be interested to know what sort of angel should I be looking at. From a VC perspective, what kind of things have you seen angels doing? We've heard from Chris about taking too much equity from the outset. What other examples do the panel potentially have where angels have made things a little bit tougher for an institutional funding round come in? Jeffrey, do you have anything you can think of?
Yeah, I guess it's a little bit about what I spoke about before in that, sometimes we can see angels coming in and wanting just a bit too complicated a structure to start with, and that can lead to problems further on. So, coming in with a really light, simple agreement is always works well. Advanced subscription agreement, stuff like that really, really works. But yeah, I think we've seen in the past just a bit overcomplicated structures to start with.
Katie, have you seen anything, any troublesome angels in the past as well that you've been working with, or has it all been pretty plain sailing?
I think in general, I'm a massive fan of angels, and Jamjar, we transitioned from being angels into operating as a fund, and so I suppose I don't want to throw stones from glass houses.
Yeah, no, quite right. It's your background.
Yeah, I see loads of value in angels. I've rarely had a bad experience. I think Jeffrey's point is a really good one around just give a structure and an evaluation that means that you're making it likely that a VC can come in at the next round if that's the right route for the business. And I think be clear about if you do have an angel that's very operational, just be clear about the way the compensation with that angel works up front. So there's not awkward conversations at the next round in terms of directors' fees or equity stakes or options. I think having that ironed out works well in terms of if you want them long-term involved, think about how that can work within the context of a wider round, rather than having an awkward conversation where they suddenly expect something that's not realistic. But yeah, in general, my experience has been very positive, and most of the deals we do have angels either that have come in before or coming in.
And fundamentally, angels are aligned. They want to make sure that the company gets the second, third, fourth, fifth stage of round of funding that it needs to kind of grow, scale, and hit the metrics to create exits for everyone in the cap table as well. So it's an important thing. And I guess, we've seen, and Chris, I know that you add a lot of value to a lot of the companies that you work with. I mean, Carlos, what sort of examples have you got around that kind of value add, that core value add from angels? Because I guess you could see it as a bit of a shopping list for founders to keep an eye out for. Have angels got X? Have they got Y? Have they got Z? I mean, what sort of things do you think a founder could be looking out for?
Yeah, so I'll answer this question in a little bit of the one you asked before. So it's a double-edged sword. If you have a group of angels, it is both your biggest strength and also not weakness, but rather sort of something to consider in terms of the logistics of just running a company. So for example, on the logistics of running a company, like getting approvals or getting anything that requires multiple signatures when you have multiple angel investors can be something to figure out and think about how you want to manage that. And is there a cutoff point for like people requiring approval on things, like on a percentage ownership basis? That's just like hygiene. However, if that's the challenge to overcome, the benefit is that if you set up structures where you can leverage the angels, you can achieve quite a bit. So, for example, one of the things that you can do is in your updates to investors, you can say, hey, does anybody have an introduction to this person? Does anybody have access to this company? And because you have a variety of people who've worked in the industry before, you can usually unlock quite a bit of resources far more quickly than you would simply by doing like a one outreach.
And has it changed, Carlos? I mean, the dynamic between angel and VC, you've mentioned that it's grown up as an industry from an angel perspective and the sheer amount of capital being deployed. But has that symbiotic relationship, if it is symbiotic, have you seen that changing over recent years? Has it improved? Where do you think it sits now over the last decade? So?
Yeah, so I would say it's gone through, I think it's gone through like a series of phases. And so one phase was like the discovery phase, discovering which investors were going to invest long-term versus just a one-off. And now we're in the stability phase where there's quite a bit of angels that are repeatedly investing. Right? And so then there's a renewal phase where as soon as there's one large exit of a company, there's a whole bunch of new people who have just been made millionaires who want to start investing again. So it recycles into the discovery phase. And so I think, 5 years ago, 10 years ago, we weren't even at the discovery phase, but we're now at this nice cycle of discovery, stability, and renewal. And that's the VCs are basically looking at how to best connect founders and angels to be able to really take advantage of their industry experience.
Jeffrey, you guys, you've got a seed for SEIS fund, an EIS fund as well as mentioned.
Yes.
So you're going in really early. You're going in kind of Series A, Series B a little bit as well. We start to cap out a little bit there. How have you seen that dynamic change and shift?
I think the most noticeable thing for us is that we've kind of seen it be really distinct, whereas it was kind of merged across fields. So we now actually see distinct angels who come in, in the traditional sense where they just want to come in very early, stay early, not really follow the money too much. And then now we see this new angel, if you like, where they want to come in. They have a lot more to offer, a lot of experience, skill sets, and they want to follow the money. So I think what we've seen is that kind of part where you have these two distinct groups more.
And I guess, Chris, you've seen quite a lot around from Angel to the VC side. How do you think things have changed?
I think I'm seeing some of the larger funds value the network of angels in particular, and I think we've seen this all with this emergence of these scout programs.
Yeah.
So Atomico, Sequoia,
yeah,
all of a sudden there's dozens of scouts, all over the place. Often you don't know who they are, right? But often they're people with some of the strongest networks. And I think this is, some of the larger funds doing two things. One, it's a traditional Series A or B investor is now dabbling in Series C, and they don't really have the network to do that. But also acknowledging that, you could have a great data set, but ultimately you don't have the relationships, and the relationships are still down to people, right? And so I think that's really interesting. And the other thing is when you look at this emergence of these micro funds and who the LPs are, they're not institutions. They tend to be, successful entrepreneurs, right? So I think when you see sort of smaller funds, almost like quasi-angel syndicates, the LP base is really interesting because you might have, 100 people that all have their own distinct networks that, collectively are very powerful and in some respects would be of more interest to a founder than a larger fund that perhaps has an LP base that are just institutions that aren't going to do any heavy lifting.
Yeah, no, it's interesting. Actually, it ties in with and it actually asks a question from the other side. It's an interesting question that's come in from Slido, and do feel free to post any questions. We might have time for a couple before we finish out. The question is, I'm going to ask it to you, Katie, if I may. How do VCs view angel-heavy cap tables against future funding rounds? Should more angel syndicate use nominee type structures? So it's kind of interesting to see when you've got lots of angels can add a lot of value, but actually, how do VCs see that, Katie?
It's not necessarily a bad thing. Of course, a nominee structure is simpler because it's just a less complicated cap table. But it's not always realistic to have a nominee structure if you've had a diverse set of angels that don't know each other, and you, as a founder, kind of built up from your own personal network. It's not realistic that they'll all join in the nominee. Having said that, if it's an angel group who are all best friends and have been investing together for years, you would almost expect them to have the single structure. So yes, it's an advantage, but it's not necessary. I think if you do have a long list of angels, there's some cap tables we're on where we're talking like 50, sometimes plus 50, the kind of pre-seed or seed stage angels that are involved. And again, it kind of depends on the strategy of the founder and their funding round, but often in that instance, if you are bringing a VC in, it just makes things more complicated. Signings take longer, so you've got to get 50 signatures. Consents take longer. So, yeah, it can create complexity that doesn't need to be there, but it's not an insurmountable hurdle.
Carlos, wrap them all up, stick them in one, or have them individual, not really fast either way? Or is there a magic number whereby it's nominee structured time? What are your thoughts on that?
I think I'm just going to echo what Katie said in terms of simplicity and the governance. I think you're always going to optimize for the simplicity of both structure and governance, but the issue is usually led by large angels. If you're a very large angel, you're probably going to want to have your own independent position in the cap table with different governance. So I think it's circumstantial, really, but otherwise optimized for simplicity.
No, thank you. Jeffrey, what are your views?
Yeah, I have to agree with Katie. I mean, it is about simplicity for me. It's the investor consent, it's making sure we manage that process. It is really trying to get it into nominee structure. We tend to favor nominee structure.
Yeah, and it's becoming, I guess, a bit more of a challenge, more common now. Average angel investment per deal is still, 20 to 50K, but actually we're seeing the democratization of angel funding through crowdfunding, et cetera, et cetera. So we're seeing, smaller tickets, more investors coming in, so it become ever more of a challenge moving forward. So yeah, look, thanks for the question, really good question over there. It'd be good to, I'd quite like to move on and have a little thought for, I guess, some of the, what kind of, taking the kind of founder's perspective. They're going to have, they're early stages, they've done a friends and family round, they're starting to look for their first angel rounds. They're planning on a Series A, but they're going to have some decent traction before they get there. The funding required before all the angel funding rounds, potentially, they're looking up quite a steep mountain of work there. What kind of things do you think a founder should be looking for? What attributes within an angel should they be looking for at that early stage? I'll start with you in the studio here, Jeffrey.
Yeah, sure. I think first and foremost, you want an angel who understands your space, has a complementary skill set that can really help you. I mean, early stage companies, as you know, have very limited resources, and any help they can get is beneficial, but also access to networks I think is important as well. So I think those are the three things I would say.
No, awesome. Chris, what are your thoughts? What sort of things the founders should be looking for? Because it's not all about, just the angels putting their money in. There's much more to it, but also founders should be doing their homework on investors too. What would you be looking for from a founder's perspective?
Yeah, I mean, my big thing is I'm looking for founders, certainly at the stage I invest, that are open to mentorship, right? So like when I come across a founder that frankly is too arrogant, I generally lose interest because I think they need to build lots of bridges and they need a lot of help at this stage. And obviously I want to back someone who's incredibly capable, but I also want someone who's humble enough to realize where the gaps are. And then I'll try to fill some of those gaps myself, or more likely fill some of the gaps with people in my network. So I've harped on for a while here. I think angels should act as more like mentors, right? And I've had my fair share of Sunday night calls with founders, ahead of a Monday morning board meeting where I'm the sounding board, right? Because I'm the safe person there. But like I said, I work for them. I write the check and I work for them. And I think it's about the if you're a founder, it's finding angels that have that attitude, hopefully. And then the flip side is finding angels that want to learn as much as they want to teach. So, I think if you're a founder and you have a bunch of angels and everyone's a know-it-all, that's no good. I think if you're a founder, you want people who can provide value, but also are inquisitive and still want to learn. It's a much more healthy dynamic.
Carlos, what are your views?
So really, I only have two things that if I were a founder, I'd really be looking for in my angels. One is experience in areas that I don't know as well as a founder. Somebody, for example, if I'm not a product-centric founder, I have all the commercial chops in the world. I've worked in selling contracts before, but I don't really fundamentally understand what makes a good product. I would look for somebody with that experience. And the other one is access to key go-to-market relationships. It's so hard, especially even if it's particularly when it's an enterprise software type business where you need to have 1 or 2 or 3 key connections within large customers to really get that door open. I think those two things are huge value adds that angels can bring.
Yeah, amazing. And Katie, I guess, Carlos touched upon access to markets and that kind of go-to-market structure. I mean, you guys are famously focusing around a lot on that B2C. You've got a good background from B2C as well. I mean, is that the sort of thing that you look for and work on quite hard with the founders that you invest in?
Yeah, so we only invest in consumer brands. It's mostly digital consumer brands. And we draw from our collective team experience in backing solely brands and having run brands, chiefly Innocent, which my 3 partners founded and ran for 15 years as CEO. So, yeah, I think that's the most common reason we're brought in. It's our experience, it's our operational experience, and hopefully our attitude as well, which is, to be in the corner of the founders and be people that can be confidants to the founders, rather than the big money at Series A. So it's a different type of relationship with us. I think for me as a founder, I would be looking for just two things, which is angels I can trust. That doesn't mean that you have to have known them for 20 years, but no red flags in terms of trust. You want people that you want to have around the table and you want to have a relationship with, and then people whose advice I respect. At the end of the day, you're going to do what you want. It's your business. You may or may not take advice, but you at least want people whose advice is worth listening to, and then you can draw your own conclusions. And if you don't feel interested or respect that advice, then I wouldn't waste your time having them as an angel, unless you just need the money. In which case, get people that
Quite
don't want any involvement whatsoever.
Yeah, the most passive investor you can physically find who really likes writing checks as well. Yeah, always a bonus to have those on board.
It's much more useful to get
the value add.
Value and money.
Yeah, for sure. And I guess, from a founder's perspective, it can be hard to find great angels who you can trust, but feel free to do a background check. Find out where has that investor invested previously. Do a reference check on previous founders they put some money in, so you can start to build that trust as well. I think we've got a couple of minutes left, and I thought actually we've got a lot of angels in the audience, we've got a lot of founders in the audience. I think it'd be really handy to give them a kind of a feel for the kind of businesses that you guys all collectively like to invest in. So what kind of things? So Jeffrey, let's start with you. What sectors? What amount? What kind of check sizes? What's your sweet spot? What are you looking for?
Well, we are agnostic first and foremost, but we like digital platforms, digital marketplaces. We do a bit of deep tech and we do a bit of product as well, but we really focus on that. Seed, pre-seed. Of course, we've got the pre-seed fund, and we use that to kind of feed our seed fund. So we look at kind of small check sizes, very very early stage, kind of sub $1 million.
Very quick questions come in specifically for you. Are angels a great provider of deal flow for funds? You've got about 15 seconds.
I think angels are an excellent provider of funds. They do the pre-vetting for us, and especially if they're going to bring money in, absolutely yes.
Excellent. I think we're getting some great vibes about angels because I'm the UK Business Angel Association, so they're on their best behaviour. Katie, what a jam, you've touched on it already, what a jam jar looking for? What stage of business, what amount, what sort of check size?
So we only back consumer brands, mostly digital consumer brands. We're looking at early stage, so typically at seed or Series A, but anywhere where we think we can make at least a 10x and the business can be worth £100 million plus. That's it.
Cool. Carlos. CCAP.
So we invest in pre-seed and seed. Yeah, sorry, I think there was a little bit of an echo there. So we invest in pre-seed and seed, anything that is around of 2 million or less. We're usually part of a syndicate of angels. That's pretty common for us. And in terms of sectors, we've covered so much over the decade or so of our investments. We've covered fintech, crypto, we've covered healthcare, as mentioned earlier, digital platforms and marketplaces. Really open to anything that is capital efficient. It's fun to see how much we still have to grow in terms of like new ideas, new places. So, really open to anything anyone has out there that is going to radically change the world we live in.
And finally, Chris, what are you looking for? What sort of businesses are you interested in investing in?
To wrap it up. Yeah, I'm pretty broad. Fintech, early stage, obviously, insurance tech, wealth tech. I've invested in a number of banking as a service platforms early on. So early investor, first investor actually in Rails Bank, and now subsequently some other banking as a service platforms in Africa and Middle East, and as well as sort of like at the intersection of clean tech and fintech, wealth tech. But again, sort of early stage founders that I think I can add value to and that I get on with. So it's been fun. I've done 22 investments since the 1st of January this year.
Amazing, super active as well. Well, look, I think that's all we've got time for. So I want to say a huge thank you to our panelists, Jeffrey, Katie, Carlos, and Chris. Thank you so much for joining us. That's been a great session. Thank you, everyone. Thanks, guys.
And thank you, Rod, too, as well as our panelists. You're all angels for joining us today. If that discussion or any other topics have particularly resonated with you today, please do pop into our next networking session. It could be the most valuable 10 minutes you spend today. We'll see you back here shortly.